All right, looks like we're live. Welcome to the stream. So, today's topic is silver. So, wanted to get to this yesterday, but we didn't get a chance to because we were busy talking about some connections with Overstock.com and GameStop. The naked short, the naked short situation is similar in both of those stocks, and we started putting together some of the pieces and seeing overlaps and looking at trade moves in trading from insider trading forms that were filed with the SEC at Overstock, and comparing that to price moves in Overstock, and also looking at overlaying that with the GameStop share price too. There's some interesting findings that we made there. And then it seems Patrick Byrne came out yesterday, the same day, and he linked to his own website. I think it's Deep Capture, I think is the name of his site. And he came out saying that a lot of people in GameStop are interested in the backstory of what's going on there. And it's a story of naked short selling. And nobody knows that better, I think, than Patrick Byrne, who was the CEO of Overstock for many, many years. And they had 12 years or 13 years ongoing litigation, something like that. I think it may still be ongoing litigation from Overstock.com to many Wall Street banks, including Goldman Sachs, who were naked short selling Overstock shares, or at least that's the allegation. So, sorry about that. Had a phone call coming in. Anyway, we're going to talk about silver tonight, and silver has a lot to do with this. So in my view, there's one big rolling campaign going on, and this is not a campaign of individual retail investors. This is a campaign of people who are looking to take advantage of the naked short selling that's been going on, not just in Overstock.com, not just in GameStop, but ultimately in precious metals. So this isn't just about silver. It's also about gold. It's about hard money. A lot of people who are new to investing in silver, they probably don't know a whole lot about the how hard money works, or a gold standard. And so we could talk about that a little bit. I've got a few charts up, but let's talk about first, what does naked short selling have to do with silver? And people are talking about, here in Reddit, people are talking about silver is the next thing. And then people are saying, oh no, don't go to silver because it'll take us off of the things that we're already on. Well, I got news for you. You got to find these trends as they're emerging. If you're late to the party, and people getting into GameStop now are late to the party, you've got to find the emerging trends. And so it's like, if you think you're going to get in on the Overstock.com short squeeze off of the March low, well, you missed it. It came and went, and it doesn't mean it's not going to get squeezed again. But I mean, that party's over. And is the GameStop party over? I'm not going to say that. I mean, it's down sharply off the highs. And I mean sharply. In after hours today, it was at, this is February 1st, 2021. It was down to, I think, 195 was the last price that I saw in after hours today. Some of the big people, the champions of the Reddit movement, are still holding the guy Deep Fucking Value. I think he posted a screenshot today. I saw it. It was a repaste. I didn't go on Reddit and look, but I saw a screenshot that somebody pasted on Twitter of what he was still holding his same position. It was 500 long contracts and I think 50,000 shares. He hadn't liquidated anything other than the original $13 million of sales proceeds that he had already been sitting on. The rest of it's still in his position. So he's still holding on, and I think that's giving a lot of people faith, but I think in my view, the next ship is getting started to rise. And this isn't about individual retail investors. This is about, it's about essentially a chain reaction. If you think about Overstock.com share price at under $3, and then you think about it's over 100, while GameStop is around $3 or $4, and now GameStop is it's over 100. It had been over 400, and now we're seeing silver, and it's under $30. And so what I'm going to suggest is that $30 silver, to the people, the institutional, or the let's call it the whales, to the whales that are making these moves, and it's not retail investors, because look, I mean, this guy Deep Fucking Value, he made his purchases in the beginning. There was no further lift from him other than research which he shared. And so maybe other people piling on, yeah, that's a factor, but it really, I mean, this happens all the time, and you can move penny stocks like that. People do it all the time, but to move something that big, it's not typically just retail people, and their participation matters. It matters a lot, and unfortunately, a lot of them are going to be holding shares purchased in the hundreds of dollars. At some point in the future, it's pretty likely that the GameStop's not going to be over hundreds of dollars. Now, it may go over 1,000 first. That's possible. But I mean, it's also likely that it's going to go under 100. So anyway, the silver at $30 a share, to the whales that were running GameStop and Overstock up from $3 a share. I think this is looking like another opportunity. So let's talk about some of the other big moves in history which has happened with silver. I was in it. I was actually in a coin store on the weekend in, I think it was 2011, when silver peaked at $48 an ounce, something like that. And we can bring up those historical prices. I might already have a price chart open. I've got a bunch of links ready to show. So let's see if I've got this exhibit ready. I've got the gold price. I've got that one ready. Let's pop that up and take a look at that. So on here, this is a site Fred. And so as usual, I'm going to call this out for people who are listening. I'm going to talk about what we're looking at, so that if you're just listening, you can hopefully paint a picture in your mind of what we're seeing. So hopefully that picture's showing up for everyone. I can't be certain that everyone's seeing that. If you're watching and you can comment, can you drop a comment if you see the Fred site with the gold fixed price up? So that's what I'm trying to show. So anyway, let me just continue here, and we'll talk about what the gold price looked like in 2011. So it had risen from a low in 2000. It was a long move, and it fell. That low was around $300 an ounce. It kind of made a nice long base. Let's call it a decade-long base. And it started rising ahead of the 2008 financial crisis. And that financial crisis happened, and gold temporarily went down. And then it really doubled again from there. Hang on one second. I've got a call coming in. Can't take calls right now. All right. Anyways, sorry about that delay. So gold rose up to around $1,800 an ounce. Okay, I'm just going to go on mute for a second to take this call. I'm sorry, guys. I'll be right back. All right, I'm back. Sorry for the delay. Okay, so gold had risen from $300 an ounce to $1,800 an ounce. Silver over the same time period. Let me get a silver window open. And so silver tends to outpace gold when it rises. And so that's one reason why you hear the Reddit folks talking about going for silver instead of gold, is because you could think of silver as kind of a pressure point in the precious metals space. In fact, in the commodity space, a lot of commodities are volatile. Like lumber is very volatile, natural gas is very volatile, and we've seen a huge move in palladium over the last few years. Again, very volatile. So commodities are volatile, but gold, let's call it lower beta than silver. So precious metals. So by the way, like gold and silver have both been used throughout history as a monetary coin or monetary unit. So that's why they're seen as kind of fungible. There's a long history about that. If you're interested in the ratio between gold and silver and trading gold for silver and things like that, I've looked quite a bit into it. There's a great book by Peter Bernstein called The Power of Gold. And it gives you all of the history of monetary uses of gold, about gold as art being taken in raids and melted down, turned into bullion, which means they melted into bars which are assayed and weighed and measured, and they become interchangeable. So 2 gold bullion bars with the same weight and the same grade, same rating, same refiner, they should be interchangeable. So they stamp them with who refined it or who minted it, if it's a mint that did it, and they should have pretty much the same dimensions. So it's about volume, density, and weight, and they become interchangeable. So gold as art, or silver, precious metals as art, they may have a value add from being art, or if they're a collectible, they're rare, or they're one of a kind. They have an extra value there. The problem is if somebody comes to try to spend that, if who you're trying to trade with doesn't really, they say, look, I know you have this piece of art, but you're trying to pay off a loan. And so you're going to force me to auction this one of a kind thing. I'm not going to give you face value for it because we can only guess what the face value is. And so what happens is they melt it down. And when you're trying to pay for a raid, like conquistadors, think conquistadors, or that show Vikings, right? If you're trying to finance a raid and you have to pay back the debt, the art that you find, what they have done throughout history is they melt it down, turn it into bars and coins, which are interchangeable, and they're good for paying off debt, and they don't need to be auctioned off. And so it's really tragic because we've lost all this great art. But that's how it goes. So anyways, back to my point about silver outpacing gold. I'm going to bring up let's look at the gold to silver ratio. We can look at a gold chart also. So I don't know if people are able to see the video here. But I'm going to try and put up a silver chart anyway. So there's a site. What's that site? This site has the gold to silver ratio. It's called macrotrends.net. And what you see on the gold to silver ratio chart, and I'm pretty sure they have a silver chart too. So let's duplicate it. And let's go in precious metals. Silver price. Where's silver price? Silver ratio charts. Silver price today, live chart. That doesn't sound like it's going to be a very long chart. Yeah, it's not. Okay, I'm not sure why they don't have the silver chart, but anyway, all right. So the gold to silver ratio is really important, and throughout history, like you'll see during these eras where silver was used for monetary purposes, it's normally below 40, and it briefly can get very high. We're in one of those phases right now, and it's falling. So what this means is if you're a holder of gold and you're storing your savings in gold, it meant that for a while you could trade them for about 1 ounce of gold traded for 100 ounces of silver. And there's a thing called an in-kind transaction, and this exists in the United States. I think it's still a thing. An in-kind transaction means that you're deferring taxes. You're deferring a capital gain. And so what you could do is if you have a golden eagle, which is produced by the U.S. Mint, and if the gold to silver ratio, let's look at what it is right now. Assuming that there's availability and you're willing to pay the bid ask spread, so your gold is only worth what the bid at the shop is, and if you're trying to get silver from the shop, you're going to have to pay the ask on the silver. It's pretty wide. The bid ask spread's pretty wide for physical metals. You can expect, well, at least in the past, for gold and silver, somewhere between 7% bid ask spread. I mean, 5% if you're lucky. That's very low end. 7% to 15% maybe. That's a pretty high bid ask spread, but you could do it. You can make an in-kind transaction of gold for silver and silver for gold. One reason why you may want to do this is if you're trying to preserve generational wealth and you don't want to pay taxes on it, and you're going to sit around on those silver coins and wait until the gold to silver ratio drops back down to, I don't know, 50, 40, 30, and then take those silver ounces and trade them for gold. You could do this. You could do it with palladium too. If you're using bullion bars, you could do it you can trade gold for palladium or silver for platinum, or however you want to do it, and they will accommodate you. And you'll have to pay taxes at the end, and it may be that you do this for so long that you don't even know what your purchase price was, or you can't, if you don't have your receipts and you lose track of all that, then what is likely to happen if you have a big sale all at once and that gets reported to the IRS, what you can expect is that you probably are going to be considered to have a purchase price of zero, which means you would pay a capital gains tax on the full amount. This happens. So anyway, just some things to be aware of. And if you're new to metals trading, then now maybe you have a little bit better of a feel for it. A lot of people who are metals traders, they'll trade in any kind of coin. They'll trade in, it might be a silver eagle it might be worth $1,000 because it's a perfect specimen. It's PCGS rated it as a PR 70, which means that it's a mint proof. 70 is the highest rating, and so I don't know if that's worth $1,000 right now, but if you have a perfect specimen of a coin and it's being graded, then that's got a value. It's got a premium value above spot price for the metal. The reason I'm talking about all this is because if you're new to metals trading and you think that like buying SLV is a good idea, it's probably a good idea to have an awareness of these kinds of things too. So we can talk about SLV a little bit now. Okay, it looks like my screen is updating. It's showing charts now, I think. So hopefully you guys are seeing this. So let's talk about SLV for a minute. Anyone going into SLV in a big way, it's probably a good idea to read the prospectus. What you're going to find in the prospectus is that there are a lot of escape clauses for in the event that physical silver can't be obtained by the custodian. And they may or may not be backed by silver. They may or may not have silver in a vault somewhere with that's tied to them. And it's similar with futures too. There's a zero hedge article today I wanted to show. I have to mute again. Sorry. I'll be back in just a moment. All right, never mind. Okay, so I've got this article up, and the headline is, this is a zero hedge article from today. It says CME hikes silver margins by 18%. Paper physical disconnect set to explode. So they're talking about the paper market and the physical market disconnect. So I've been talking quite a bit about the physical market, and the paper market is things like SLV. It's silver futures. So silver futures can be settled in cash. So if delivery is not possible for the silver, then there are ways that they can get out of it and they can settle it for cash. So, I mean, silver in hand, there's a cost to that. You're really storing it yourself. If you're in paper silver, you're essentially paying the market to store it for you. The Sprott ETF, the PSLV that people have been talking about, that's better because they try to have a one-to-one silver. They're not trying to use escape clauses. You may want to read that prospectus also and decide which is a better fit for you. I'm not a financial advisor. I can't tell you what's a good fit for you, but I can talk about these products, and I can help point you at things that you might want to consider if you're trying to make a good choice for your household or for your family or whatever, or your money, how you're going to invest it. It's something that you need to consider carefully. So, one second. All right, I'm back. Sorry for the interruption. Okay, so anyway, you guys can go check out this article for yourself. It's out there today, February 1st. And I want to talk about an example in the past where we have seen products disconnect. So people are probably aware of VXX. It's an ETF. Let me show you the stock chart for VXX. And I want to talk about a similar product, which is a derivative of VXX, which was XIV. I don't know if people remember that, but volatility went bonkers in 2018. I think it was February 6th, 2018, and volatility started to skyrocket. And XIV is an inverse product, an inverse volatility product. Well, the problem with it, there's some problems with that. Let's look at the VXX chart and talk about that for a minute. So here's VXX, and you can see on the left side of this chart where VXX rose from around $13, $14, $15 region, and rose all the way up to 70 or 80 region. And if you're an inverse product, what does that do? It means that you're just about worthless. So this happened to VXX and XIV in February of 2018, and it happened in an overnight session. And VXX was up, I think it was hundreds of percent or something, just in one overnight session. And I made a trade on it. I bought XIV at a very low price. I think it was like $15 or something. And if no, maybe it was 25. I don't think it had gotten to 15 yet. I think I bought it at 25 and was out at 15. I got burned on it. The reason I got burned on it is because it never came back. And so when we talk about products like PSLV and SLV, these are derivatives. And if the market disconnects and goes haywire, so had I instead shorted VXX, I would have made money because VXX did come back down the next day. But XIV never bounced back because it had a termination event, which was in the prospectus, that got triggered. And so it never came back. And people who bought VXX to get exposure to short volatility did not make money. People who shorted volatility futures and were able to hang on to their position, they did make money. People who shorted VXX and were able to hang on to their position, they did make money. But people who bought the wrong derivative, which was buying VXX, they did not make money. So that's a historical example that you guys can look up. It was an epic collapse. So picking good ideas for how you're going to express a view in silver is super important in my view, because silver is a factor in the financial system. Like, we have a currency that's not really backed by metals or anything like that right now. However, the monetary function of metals is probably never going to go away. So let's talk about, I want to talk about a trade that I put on today. So this is HL. It's Hecla Mining, and they have a lot of exposure to silver. So I mean, when you're a miner, you unearth all kinds of things, but you might encounter diamonds or gold, and of course you're going to take that and sell that too. But I think Hecla is one of the miners that targets silver-rich deposits. So areas in mines that are known to have high concentrations of silver is where Hecla tends to do mining. And there's a number of them. We'll look at some more in this podcast tonight. So when silver opened this morning, it was up a lot. So I'm going to look at SLV and show you the chart for today. Let's just look at... So this is a daily chart right now. Let me make this bigger. And let's look at not daily candles. I want to look at 15-minute candles. So see this big gap up? Well, here's what this chart's showing. So silver made a really long base, and it still kind of was in a base. It still kind of is, actually. It's not really fully broken out yet. This gap up in the first 15 minutes here, pretty much anyone who bought silver in the first half of the day, they're underwater a little bit. So they're kind of late to the short-term party. People who were carrying it from last week, they're ahead. They may have added to that position. That's what I did. I had silver from last week and I added to the position, but the way that I expressed that trade was different than the way that I had it on from before. So I had options positions. I had a long call options combos on. And what happens when this big volatility comes in, I mean, this is not a ridiculously huge move, but it's a pretty big move for silver. Silver moves up 5-10% sometimes in a single day. So I knew coming in that I was going to have to pay up for the options premiums quite a bit. Let's look at a call option for SLV, and you'll see how when silver faded today, that the call option faded more. So if you bought an at-the-money call option at the open, let's look at that. So let's look at, I would say, a $28 call option in SLV. Let's take a look. Okay, a $28 call option. Let's look further out in the calendar. I'm going to look out in, say we were taking a fairly long view. Let's look at July. Okay, $3.75 is what I'm seeing as a close price. And silver was up 8% at the open, I think, in SLV, and it's up 6% right now. So 2% drop. Let's look at what happened with this option. So I'm going to chart it. You would have had to pay $4.50 for this option at the open, and at the close, it's $3.70. So that's kind of a hefty drop. So what I did is I went into PSLV with money I wanted to get into silver at the open. Let's take a look at PSLV. The reason I went with PSLV, because as I've already explained earlier on the stream tonight, PSLV has a what I think is a better prospectus. So when you get into a derivative, there's a business model behind it. And I think the business model for PSLV is more aligned with my investment interests. So that's why I did it. So PSLV is up 7% at the close. SLV is up only 6%. Now, I don't know if this is due to after hours moves or something like that. I mean, they're both up about 8% gap up this morning. Never mind that the prices are different. I mean, this may only help you if you're a small investor and you're trying to buy shares, and $26 a share looks like a lot to you. There may be some interesting options, different things you can do with options with these things at the different prices. But so anyway, I went in with an SLV position, and then when silver faded back, I sold it actually and rotated into calls on Hecla Mining. I'm going to show you the calls that I got. Go in here. Now, I'm not saying that these calls are a good idea to buy now. I'm saying, like, you know, for me at the time, this was it was, I think, a good move. So what I got into was I got the September one. I'll show you an interesting thing. So if you may notice, the silver and other precious metals, the options chains don't have a whole lot of room up above the strikes. I'm not sure if that's the dealers in the system trying to constrain huge moves, because like if $20 strikes on Hecla were available, maybe I would have been looking at those. I don't know, but it was only available up to 11. And if you look at the next calendar available is January 2022. It only goes up to 10. So you further out, and it doesn't even go as high. And then if we look in a little bit in June, we see that one only goes to 10 too. So I spotted that the September ones went to 11. I thought, oh, okay, great. Well, I like that. I also like the duration. About 8 months away. So let's take a look at this one. So I'm going to open up the... oops, not order entry. Didn't mean that. 11 chart. There we go. So this thing opened at around $1.60, and it got down around $1.20. And you know, after this pullback, that's when I was buying these. In fact, I was buying them here in this cheap region, and not a whole lot, just incrementally adding. There's no reason to be in a rush to buy this. Just adding little bits. And so, anyway, the point is, had I paid up for this, I could have lost 30% on the money which I had invested. But instead, I ended up losing just a teeny little sliver, tiny little fraction, like maybe 1%. I lost 1%. And I rotated into these cheaper options. So the reason I'm going into options on miners, let me explain that a little bit. And I'm going out of the money is because here's what, at least right now, this is what my kind of medium range plan is. Sometime between now and September, if silver has a huge move, I imagine it will spill over into the miners. And what can happen is, let me show you, let's go in here and look at the analytic tools and performance profile here on this contract. So if you buy it right now, you're going to pay, well, okay, if you bought it today, you would have paid let's just say $135 a contract. And if Hecla goes up 100%, and let's give it a few months, okay? Let's look at in let's say March 20th. That $135 investment has a gain of $422. And here's why that's important. So there's a bigger strategy here, and I want to discuss it. So give me a second, because I want to bring up a calculator and show you guys something. Okay. So I have $535 for a contract that I bought for $135, right? Or no, did I do that right? Maybe not. Hang on. $135 plus $422. Okay, here's what where I'm looking at right here. If the share price is up 100%, Hecla Mining is at $14.56, and the contract has a gain of $422. So it means that that contract is now worth $557. Let me put that in the memory on the calculator. So one share of Hecla, let's look at 100 shares of Hecla. 100, and that would be what? This 1456 times 100, that would be 1,456. So the value of one contract is worth about 30 to 35% of 100 shares. Well, if the price continues to rise, I can't show you on this tool, but at some point, the contract will start to be worth almost as much as 100 shares. It'll get closer and closer and closer. And so what you could do is you can start to exercise the options contracts and take possession of the shares, and the value of the contract will be collateral, will be all the collateral you need. And you may have to sell a few contracts to get the rest of the collateral that you need to exercise. So the objective here, my objective here, is if silver sees a huge move, we could see the silver miners make a move of 500%, 1,000%. I mean, I don't know the limit of it. But the point is, at some point, these contracts, I hope, will be worth enough to start to exercise and just on their own collateral and take possession of large amounts of shares. And then what I can do is I can move those shares from a margin account to a cash account. And then now these miners are, I'll explain the reason why I'm intending to move them to a cash account. And it has to do with derivative risk in the system. So there's every now and then brokerages run into trouble. A famous one that you might want to look into on your own is MF Global. Maybe you've heard of MF Global. They went under in 2011 when what they were doing is when you have your money in a margin account, and they were running margin accounts and futures accounts and things like that. I think they were a pretty big futures broker. And what they would do is they have the ability to essentially side pocket your money overnight and invest it in investment grade, certain asset classes. I think sovereign bonds might qualify. And so if you look, you'll see that Italian bonds had a huge move. And it was a huge move lower. And so what that meant is that the interest rates were really high on Italian bonds. And when you make an investment like that, you're essentially betting that the yields are going to come back down or stay where they are, and that you're going to get paid that interest. And if the yields fall, that means that the prices of the bonds go back up, and you actually have a capital gain. And so you could do this during certain periods with as a brokerage. You can essentially like sweep the customer money into an account and put it in short-term government bonds and earn interest on it. And then what you could do is you could rebate some of that interest back to the customers. And so a lot of customers are fine with this because they're getting paid extra for cash they have in their account or for like extra margin that they have available. It's an agreement between the customer and the broker. So it's not like doing anything shady. However, if you're making concentrated bets into bonds that become high yield relative to other things can get bad. And so this actually happened, and MF Global went under. And when they did, customers in accounts that were of the type that could make these kind of agreements with the broker, where it's, hey, this is a margin account, and extra margin that I have available when I'm not using it, you can put it in government bonds and earn interest, and I'll split the difference. Me and the broker will split the difference. If you have your money in that kind of account, and pretty much most margin accounts kind of fall into this category, you can check with your broker and see what their arrangement is. I don't know. It's different everywhere. And so if you have a cash account, that falls into a different category. And so that's funds that are in a cash account they're not assets that are in a cash account are not really subject to these same kind of agreements. They're in a different side pocket than the customer funds that are in margin accounts and the assets that are in margin accounts. So when MF Global went under, the margin accounts, people who had, clients or customers who had money in margin accounts, a lot of that got frozen, and they had to wait for really long periods of time. And if you were in a cash account, I think those customers fared a lot better. They were able to transfer their assets over to a different brokerage and get access to their money much easier. So when a broker fails, it can cause a chain reaction, cause other brokers to fail, potentially. And so that's the reason for this plan. Because if silver goes up enough, what that is implying to me, or like one interpretation that people might have, and that I might have, is if commodities like silver are really going up a lot, that may imply that a lot of bailouts are happening behind the scenes. So it may be that the derivatives market is exposing certain players to losses and that they need to get bailed out. So when MF Global went under, what happened is one or more brokerages essentially step in and take it over. And these are typically brokerages that maybe they were competitors before. And so they get access to that client list. So, it's kind of a favorable situation for them too. And we see this in banking. It's not just with brokerages. It's a similar thing with banks. There's a long history of central banks and regional banks, and it's really interesting. The world we live in today is a world where banks operate pretty much without borders. And there's good and there's bad about that. In old times, banks would be invested in the community, and they would make loans to people who wanted to buy houses in the community. They would make loans to businesses in the community. And the people who lived there would put their savings into those banks, and they would earn an interest rate that came from the loans that the banks made. And when you make a deposit and you have your money in a checking account, you're basically saying, I want to have access to this money at any time. Well, it's hard for the bank to lend that out if all the customers might take the money out at the same time. So that's why there's things like savings accounts. You're saying, like, essentially you're letting the bank know, I intend to park this money here for a while. And the bank says, oh, well, if you're going to park it there for a while, that means that I can be more aggressive with loans. and so I can afford to pay you a higher interest rate in the savings account. And if you're willing to lock your money up into CDs or certificates of deposit, and these are typically for a duration or a term, and there may be a penalty if you want to access the money earlier than that. Then they could pay you even higher interest rates. And the longer you lock it up, the longer that they can pay you higher interest rates. So these are just foundational concepts of the banking system. And so anyway, so back to silver and silver miners is if there's a whole lot of trouble, what central banks may do is they may make loans to the most well-capitalized banks and brokers so that they can take over the assets of the ones that got in trouble. So the survivor banks, the big ones that fared the best, or they had the most conservative investments, they may not want to take on all of the risk themselves, and so they may band together, they may pool money, or what they may do is borrow money from central banks or from each other to do these takeovers. And so one of the symptoms of borrowing money in our system is that when a loan is made, it actually creates money. So the central bank sits down and says, okay, I'll make you a loan. Well, they're essentially like creating that money into existence and putting it into the system. Well, one of the side effects of that is that can, in a high money velocity situations, that can lead to price inflation, where prices are going up for commodities and things like that. Now, we're not in a high velocity money situation right now. I'm going to show you on Fred that the velocity is really low right now. So let's go take a look at that at the Federal Reserve Economic Data site. I'm typing it in right now. Let's go over to Fred. So money velocity is a big deal. Let's type it in here. Velocity of M2 money stock. And you can see that it's really cratering. And so if this ever picks back up, that could be that could lead to price inflation. So when I talk about inflation, I'm going to be a little bit more precise than when most people talk about inflation. They think that inflation is it's rising prices. I'm going to distinguish between the inflation of the money supply and asset price inflation because they're different. So velocity, you can have inflation of the money supply without asset price inflation. And velocity has to do with that. So when velocity is dropping, and you can see it's been dropping for my entire adult life, money velocity has been dropping, according to Fred. If this ever picks back up, and I'll give you, let me put a picture in your mind of what that might look like, of money velocity picking back up, is people taking wheelbarrows full of cash and going to the grocery store and buying a loaf of bread. That's like screaming high money velocity. That money's flying, that cash is flying around. So I don't know what all exactly is contributing factors to why this velocity of money is dropping, but I may try to have a guest onto this live stream. I could think of quite a few that could speak pretty well to this phenomenon, and it's a factor. So if you're going to be investing money in silver, just be aware that there are so many factors like this one that are going to play into whether or not your investment makes money. It has to do with the prospectus of the derivative you're purchasing. Or if you have shares in a miner, well, that miner may outperform other miners or it may underperform other miners. They may run out, they may halt mining. Here's another factor you have to consider is that mines can get nationalized. I don't know if a lot of people knew that, but if you're operating a mining company, you probably don't just have one claim. You're probably mining maybe all over the world. And if there's turmoil in a country and the government changes, the new government may they may say that your agreement to mine in this spot only was good with the previous government, not with the new government. And so you can either make a new deal on our terms, or we're just going to take your mine and you no longer have a claim here. So that's a risk with miners. So there's tons of risk. When you buy silver futures, you are paying the market to store it for you. So let's look at, when you do that, you pay a price, and that price is called backwardation. I'm going to bring up, let's take a look at if silver's in backwardation or if it's in contango right now. And let's talk briefly about that. So give me a moment to do an internet search here. So, I mean, this is kind of like a live research session. I don't have everything prepared. I mean, I try and have a few things set out ahead of time. Silver price, futures prices. Okay, let's see if they got it over at NASDAQ. No, this is not what I was looking for. Okay, I think I got it. Here we go. Silver. Okay, so here's where we're looking at, guys. FuturesTradingCharts.com. We're looking at their market quotes. And we're looking at the Globex COMEX silver futures prices. The February contract. Let's see here. Does this have a date on it? Yeah, it does. Okay, February 1st. Awesome. So let's look at these settlement prices here. Settlement, $29.39. The next price down is that's a February contract. The March contract is $29.41. So there's 2 cents of contango in there. The next month, April, $29.44 has 3 cents of contango. It's $29.44. The next one, May, $29.36. Now it's in backwardation. It looks like it kind of goes into backwardation here a little bit. And the lowest one I see is September, has a $27 backwardation, or $27 price. So there is some backwardation in the silver curve. It's not really in what I would say steep backwardation. Although, I mean, 27 seems a little low. I don't know what's the deal with that. Also, there's a lot of volume in September. Interesting. Although the open interest is not particularly different from other months. So, anyway, let's talk about contango for just a moment. A lot of people may not know what contango is in futures prices. So, let me give a brief explanation for contango. That's where contango is where if you are a holder of the February contract, well, it has an expiration date. At expiration, you can either take delivery, you can liquidate the contract, or you can roll it. And when you roll it, you're essentially saying, like, I'm going to sell my February contract and buy a contract further out. Typically, you would buy the March contract if you had the February contract. And as you get closer to the March expiration, you're going to be looking at maybe rolling again. So as you roll, the difference in price you pay determines whether or not you're in a contango situation or a backwardation situation. They're opposites. In a contango situation, it means that when you sell your February contract, you have to pay more to buy the same quantity of March contracts. The amount which you pay more, you should think of it as, this is the price I'm paying the market to store this silver for me. And it's the opposite when it's in a backwardation situation. It means that you could liquidate your February contract and buy a March contract and have some money left over. And that means that you're essentially like earning money because of the fear in the marketplace that there isn't going to be enough supply to meet the demand. So that's what a backwardation situation can imply. But when you roll a contract in backwardation, you get paid to do it. However, it means that the market's in a state of fear. What does that mean? It means that there's panic. So it may actually mean that while you may get paid a roll, a backwardation roll, it may mean that the market is close to bottoming because, maybe it's a blood in the street situation, or that there's fear from market participants enough to maybe form a bottom. So, gosh, we've kind of talked about a lot. What other kind of things can we do? Let's talk about GLD for just a minute. That's a fun one. So I'm going to hop over to, I've got interactive brokers and paper trading mode. This is not my real account. So we're looking at GLD right now. And let's just play with this on the options because they're pretty liquid. And you have to know that GLD is lower beta. So for the same percentage move in SLV, GLD is going to move less, but they tend to be highly correlated. So what that means is that for any given day, they tend to move in the same direction. All right, so let's see if we can make a back spread in gold. So gold was up today. What was GLD up today? Less than 1%. That's a small move. So the options for GLD may still be pretty cheap. We may be able to make a back spread here. So current price for GLD looks like it was 174. Let's go slightly out of the money here. We're looking 11 days out, which is like two weeks of trading days. And how many points do I think that GLD might move? I'll show you guys a trick that I use to help me figure this stuff out. So I'm going to go over to stock charts for just a second. They have really great charts. I like stock charts. And down at the bottom, we're looking at a daily chart for GLD. Down at the bottom of the chart, I have ATR 14, and this means 14 periods. So if I look at a week, if I look at weekly bars, it'll tell me the weekly ATR. If I look at daily bars, it'll tell me the daily ATR. Daily ATR for GLD is $2.20. Let's look at the weekly ATR. If you don't know how ATR is calculated, you might want to look that up. The weekly ATR is $5.40. So what that means is that the full range over the last 14 weeks, the full range of that bar, that means including gaps, it means from the high to the low, all that included, has been averaging 5.5. And if we think that GLD may explode higher, the reason I'm looking at GLD is because it's a fairly high price, and so we can do different things with the options without burning ourselves up on commission and bid-ask spread. We could do things like put on a back spread position, maybe. Let's take a look. Where I wouldn't necessarily try to do this with SLV because it's such a low share price. Maybe we can. It might be fun to compare them, and you can see what I mean when it comes to the transaction costs burning up the gain. So let's start with 5. We're looking at 2 weeks time here. So if we think that there's going to be 2 straight weeks of up action on the weekly bars in gold, and that because it's breaking out, or the metals are breaking out, that's our assumption here. That let's expect it to be, let's build a trade around an expectation of 10 points higher in 2 weeks. And I don't know that I would hold this trade all the way, the full 2 weeks. Even if I put it on, I probably would not hold it the entire time. There's a lot of reasons for that. So 10 points higher, that's 184. So let's see where that gets us here. The 184 contract for February 12th is 40 cents. So we're going to buy one of these. And we're going to, because we're making a back spread. Oh, I'm sorry. Hang on. We got to go to the combo builder here. We're going to do a strategy builder. So actually, let's start the other way. Let's just know that our top end is 184. So it's currently, what did I say? 174. So let's go a little out of the money. We're going to sell a 177 for $1.29. Let's buy a 180 for 78 cents, and we're going to buy a second one. That's what makes it a back spread. Now, what you can do is you can sell one that's in the money or at the money. I'm going to sell one that's out of the money. We'll play with these strikes. And the idea here is we want to make a combo with our purchases that adds up to less than $1.29, because the one that we're selling in this combo is $1.29. We want to make this a credit back spread. So let's buy the 183 here. So that's a small credit. What I'm doing is I'm buying a 177 and selling a 180 and a 183. Now we're going to look at the profile. Way too big. We're going to look at for a 10% move. I mean, that would be outrageous if gold moves 10%. But this gives us pretty much, this is showing us the entire range of the picture that I would expect to see. So if we hold this 2 weeks and gold closes, GLD closes in the range of 177 to, it shows the break-even points here. If we hold this for the full 2 weeks and gold is between, or GLD is between 177 and 186, we will lose money. We will lose a lot of money. However, that's an expiration. It's a whole different story when there's still 2 weeks to go. It's this dotted line instead is where we can expect to move. And because this is a back spread, if implied volatility rises, and it might if gold has a big move up, we can expect this dotted line curve or better for, let's look at for tomorrow. So if we hold this for tomorrow and gold explodes higher, then if it rises 5%, we can make $85 if we put one of these on. And all we're risking here is, it looks like $5 of commission plus $13 at the worst point, which ironically is if it starts to rise, you're losing money at first. But this back spread, I put 2 contracts on, so it's got like this lull right here, but it's really explosive at the higher prices. So if it breaks out higher and faster than we expect, if GLD is up, let's look at the end of the week. What's Friday? Friday's the 5th. So if we look at February 5th, and gold, GLD is up 10% at that point. This one contract that it cost us $5 and we have a margin impact of $300. So think of it as we have to put up $300 with the broker to do that. That's why I split these 2 calls that we bought. I split them out so that it would have a smaller margin impact. So we can essentially double the money on the margin we put down on a 10% rise. I would say this is probably like a best case scenario. But that's a huge gain. And this is probably going to be pretty liquid. And for the next few days, it's a low risk relative to the reward. However, if I play this forward, you see if we get into week 2, by the time we get to next Monday, if it hasn't gone anywhere, you're really looking at some pretty heavy losses. It has to move a lot to make up for that. However, if GLD crashes, you're kind of in a safe zone. That's what's so nice about a back spread relative to just buying an outright call. And so what this means at this back spread is if it closes below at expiration, if GLD is below 177, and keep in mind it's at 174 right now, if GLD closes where it's at right now or less, this trade breaks even. So, you can just let the whole thing expire if you want to, or you can sell it for a really small loss. So that's what's neat about this back spread construction that we have here. If you're more aggressive, what you could do is you could try and put the at the money right here, or somewhere closer to in here in this region on the chart. So let's look at that where the back spread we're looking at is we're selling an in the money one instead. And what that means is gold has to fall further for you to get into that safe zone where all the options expire worthless. So we said gold's GLD's 174. The daily ATR was let's say round up to 2.5. So let's drop down 2.5 and put it at 171.5. We're gonna sell one of these for $3.90. And again, we're gonna try and do a similar thing where we're building a spread for a slight credit. So let's see what we get to buy. Last time I had 3 points away, and that's why it was a 300 margin. So that would be here for the first one we're buying. It would be a 174.5. And we've still got $1.50 that we can buy one for $1.50. So let's buy this one. So we're selling one in the money and buying two out of the money for this back spread. And let's compare it in the profile. So that one looks like this. You can see it makes a lot more money for a 10% rise in GLD. It makes almost twice as much. It makes, I'm sorry, let's look at, I got to go out to February 5th if we're doing apples to apples comparison. Yeah, by that point, there really isn't any time decay left in it if it's 10% higher on this one, because it kind of gets into this safe zone a lot sooner. And it's a 1,100, let's call it $1,100 of profit. And the most that you would be down here, except for maybe changes in implied volatility. If implied volatility drops on GLD, you might lose more than this. So you had to post $300 again for this particular options combo, plus pay $5 in commission. And it looks like if the price stayed where it's at, you would have lost another $65 on the position, plus bid-ask spread, right? It's expensive to get in and out of these. Now, I'll tell you what I would do if I had purchased one of these and it didn't go anywhere. What I would do is I would roll it out a week, probably, if I still had a very bullish outlook on GLD. And what that means is you're going to be back to that 0 point where you've still got a week to go on a 2-week spread for it to take off and move your way, and it costs you $65 plus the roll cost, which is $5 on the current one to close it, $5 on the new one to open it up, and you're probably down by around this $65 amount. And if GLD goes down or crashes or whatever, there's not much risk there. So this is a really compelling way to place trades on the metals to me. If you can be an active trader. If you cannot be an active trader, then look at what can happen to you. Is if you get stuck in one of these and it doesn't go down, you can lose the entire deposit. All this $300 of margin you had to put up. There's some point, along these prices where it's you lost it all. You lost it all in the region between the prices of 175 and 177. You pretty much lost your whole deposit. So you might look at this and say, oh, 300, so what? Well, I mean, it's the odds of winning on this, if you hold it till expiration, given by the calculator, and that's just an estimate at this time, okay? This changes every day. And when you hold this position, this estimate's going to change. Right now, it's 49%, so a chance of making a profit. So this is not the kind of trade that I would want to hold till expiration. Mm-hmm. So the reason I don't like making these kind of trades and things like SLV is because if we go over and look at SLV and you look at, the commission as a percentage of the trade, because it's a back spread, you can't really look at this percentage. It's saying like, it's thinking that it's calculating this percentage based on the credit or debit instead of the margin I had to put up, which was my real outlay for the trade was 300. If I were to put this on. So anyway, and what you're going to see when implied volatility rises is you're going to find that you're going to have to push these strikes further out, and that means you have to put down more margin. And also that it takes a bigger price move for you to get to, out to this region on the graph where the price is shooting up. And if you think price is really going to shoot the moon, you want to look at a wild projection. I mean, just take a look at what's possible here with these contracts, okay? And so again, this goes back to like why there's derivative risk and why you have to like put down these kind of deposits. I mean, somebody else is on the other side of this trade, and it's if GLD happens to be up on February 8th, it's up 30%. This position where you put down a $300 deposit and that was your risk on the trade, it's up 15 times that. It's at $4,600 of gain. And maybe even more because of the rise in implied volatility on the contracts. So this is a way that people can make a lot of money from a little, but you have to be right about changes in implied volatility. You have to be right about timing. There's a lot of things you have to be right about. So anyway, this is another way that you can look at, and this is a reason why I kind of moved from doing a lot of these kind of things on Twitter. You can look me up on Twitter. If you don't already follow me, it's Jon Tait, Jontait. If you're interested in following, and by the way, if you like this content, please subscribe and pass it along, share it with your friends. That would help me out. So I'm trying to get the word out, trying to help people. There's so much crappy content out there on trading, and so I'm trying to step it up and give quality content. So anyway, it's really hard to illustrate all this kind of stuff in a tweet thread. I used to do these big tweet threads, and I kind of pulled back from doing that because I don't really. Let me just keep it simple. I'm not really excited about the Twitter platform at this moment in time, but I'm still on there, and I'm still going to be using that to make content. Although probably I'll be moving a lot of my content to here in this format. And I'm going to be playing around with different streaming platforms maybe. For now, I'm trying YouTube. Hopefully it'll be good. So anyway, I think I'm going to end it here. We've talked about a lot of possibilities for what can happen with gold and silver and miners. And we've talked about banking. We talked about hard currency. If you missed out on the beginning of this broadcast, I'm going to post the recording of this once YouTube processes it and gets it uploaded. You can start it again, rewind, and watch it from the beginning. And you could skip over the parts where I had to mute the mic and take a pause. Anyway, yeah, if you missed it, it'll be up on YouTube shortly, and you can watch it again from the beginning.